Well, it was an interesting week of upside economic data surprises last week, reigniting talk about a soft landing for the US economy once more. Of course, we've also got the first half of the year out the way as well. The equity market closing out a pretty blockbuster 6 months on Wall Street, despite the hawkish Fed repricing continuing, but the FX space remains largely range-bound. It is a holiday-interrupted week coming up this week with the Independence Day holiday in the United States and the long weekend in the mix, thinning out liquidity and trading volumes just a little bit, but there's still plenty for market participants to digest over the next 4 or 5 trading days. We've got the latest PMI surveys, we've got minutes from the last Fed meeting, and of course the all-important US labour market report is due out on Friday lunchtime. It is another busy episode of the Trade-Off UK this week, so without further ado, let's get into the show. So plenty as always to discuss on the show this week. Without further ado, let's bring in my co-host, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, good afternoon. How are you doing?
Yeah, good afternoon, mate. I'm struggling, as most people are, with this Twitter outage. I'm pulling my hair out over it, but I'm sure it's the same for everybody.
It is ridiculous, isn't it? I mean, as we were just saying, who spends 50 billion quid to buy something to then tell people that they're not really allowed to use it? I cannot get my head around that at all, to be quite honest.
No, exactly. But, if you've got the money, you can spend it on what you like. So if I had it.
Exactly that. I mean, maybe we'll be giving market updates via TikTok or something this time next week. Who on earth knows? I must say, before we get on, just on a note of housekeeping, a few weeks ago, I banned all talk of football on the trade-off, given our diverging fortunes for our respective teams. I'd like to propose a ban of any talk about cricket on the show as well, given the shambles that has developed over the last couple of tests in the Ashes. I must say, working for an Aussie firm at the moment is, it's all fun and games, isn't it?
Yeah, well, good luck with that one. I'm going to spend my day looking at the darts. I think it's about the only sport we're good at the moment.
I was going to say, I think it is, or lawn bowling or something like that we can probably get away with. Right, before we go through any other sports that England are no cop at, let's get on to Topical Thunder. So I want to talk about some of the data that we had out last week. First of all, it has kind of reignited some hopes that the US might possibly get away with a bit of a soft landing rather than the recession and the steep slowdown that a lot of commentators have been calling for and expecting. Of course, coming into the year, and we are filming this right at the start of July, coming into the year, most people were expecting that we might already be in recession at this point. But of course, the US economy has confounded those expectations thus far. And judging by some of the prints that we had out last week, it looks like that could continue to be the case for some time to come. Just to go through some of the data that we had out last week that beat expectations, and pretty much all of it did, to be quite honest with you. Durable goods orders rising 1.7% on a monthly basis, above the 1% contraction that was expected. Consumer confidence rising to its highest level since January of 2022, according to the Conference Board, and the University of Michigan number was revised up a little bit as well. We also saw an upward revision to the first quarter GDP number. I know that's horrifically out of date and a lagging indicator, but nonetheless, growth of 2% on an annualized quarter-on-quarter basis in Q1 is pretty strong. And if you look at some of the live GDP trackers and the nowcast data, I think the Atlanta Fed number is pretty close to that for Q2 as well, which bodes pretty well. Initial jobless claims fell to around about a 1-month low last week, and inflation is also continuing to cool. The core PCE deflator coming in at 4.6% on a yearly basis in the month of May, down from 4.7% prior. So all pretty good news. The market's seemingly liking the data, and I think it was interesting that we actually saw markets take good news as good news last week. It wasn't this good news is bad news, it means tied to policy, it means higher for longer. It was actually a case of this is good news. The equity market rallied quite nicely with a bit of a value, a bit of a cyclical tilt to things. And if you look at the money markets, you actually start to see higher for longer really starting to get priced in now. If you look at the OIS curve, we don't see the market expecting rates below where they are now for about a year, which is clearly what the Fed have been trying to engineer. So I'm keen to get your thoughts on all of this, Ryan. Obviously, we've got a busy week ahead, which I'm sure you'll get onto momentarily, but your thoughts on what happened last week and maybe even the fact that the FX market just didn't seem to care about it.
Yeah, well, we had all those end of month, end of quarter, end of half year flows coming through as well. So that could have muddied the waters a bit.
Who had 5 minutes 50 on the sweepstake for the first mention of that?
Was it you? It'd be the first thing you've won this year. But
yeah, very true, actually.
The data was pretty solid. I mean, surprisingly, that GDP number as well, coming in at 2%. It's very rare we get such a big revision for the final number. So that was good. Jobless claims as well. We've been seeing numbers creeping a bit higher, 260s, mid 260s, up towards 270 for a few weeks, and then boom, we get a 239 in the mix. So, again, it comes back to there's problems. Oh no, there's not. And the PCE data coming in a little bit soft on that core, as you mentioned, by a pip. Powell had hinted that it would be there or thereabouts. He also hinted what the headline PC number was as well, and that came in at 3.8%. He said 3.9%, so close enough to give us the numbers without actually giving us the numbers.
Yeah, exactly.
It's all going the right way for the Fed. They're getting inflation slowly coming down. The stickiness is still there with those core numbers, hence why the rhetoric from those guys. But the data, it's looking soft landing again, and that is going to be supportive of stocks. And as long as that lasts, the Fed are going to be staying on their message. Now, of course, does that mean they're going to do their 2 hikes? This is a time when they can be wrong. They don't need to hike if the data goes their way, because they'll turn around and say, well, the data's gone our way, we don't need to hike. But they have to keep that message in there. Otherwise, the market undoes all the good work. And that's the big fear for them at the moment.
Yeah, absolutely. I think you're spot on there in terms of what the Fed really don't want now is to loosen financial conditions. They just want to maintain them as tight as they are now, because, of course, every day that you remain with rates at their current level is another day that feeds further and further and deeper into the economy as businesses refinance and people remortgage and all the rest of it. I do think that they've kind of boxed themselves into raising rates in July now. I think it would take a pretty disastrous payrolls number on Friday for them not to do that. But I think the real question is then what comes after the summer. And actually that seems to be shaping up as the debate for pretty much all the central banks out there now. We look at the Fed and July seems nailed on. It's what do they do in September? The ECB, it's the same story. The BOE, it looks to be a very similar story as well. So, interesting few months away, that's for sure, as we kick off the third quarter. Yeah,
definitely. We're going to talk about central banks and the turn to the dovish side, or the dark side, as a lot will be liking to call it. Economic data is going to be the moves that we're going to have to watch, and that's going to bring this data dependency trading, which is what I'm going to talk about now. The data is going to test all these central bank stances, and it is a key week of data. Obviously, you're getting this on a Tuesday, so we've already had some data go under the bridge. We're going to have the final PMIs coming out of Europe, which have been a little bit softer in the final numbers for manufacturing. Same around the globe. There was a couple of small uplifts in China and Japan. Then we're going to get the ISM, which hasn't dropped as we do this. I'm going to give you the number. It's going to be 46.2. There you go. I'm going to make another prediction for you. So by the time you see this,
that right?
Yeah,
46 for evidence. It is about 20 past 2. So he's not cheating with that.
It's going to be 46.2 US manufacturing ISM. There, you can take that one to the bank. Anyway, again, by the time you've seen this, we're going to have the RBA. Have they hiked? Have they paused? It's a bit of a coin flip for that one, and what the market's going to be guessing over that. Wednesday, we get the final services PMI data from a lot of the globe and from Europe and the UK. Then really Thursday is the big day. We get 4 jobs numbers. We get, maybe 5 if you call the ISM as well. So we get Challenger layoffs, ADP, jolts, ISM services with the employment components, and jobless claims. So plenty of data on Thursday that is going to perhaps set in motion what expectations are going to be finally for Friday's NFP. That's going to be the big number of the week. And it's a double bubble because we've got Canadian jobs and they can always be fun. So any of you loony traders need to be prepared for that. But to pick out some of the bones between the numbers and what to look for, particularly from the PMIs, the ISMs, look for the prices components, prices paid, prices received. That gives you an indication of what's happening for inflation in those sectors. And also, as I say, the employment numbers, the manufacturing and services still in expansion in the ISMs. So if you get a little bit of a pullback in those or one of those knocking into contraction, particularly from the larger services sector, again, that's going to maybe change some final thoughts for Friday's NFP. All of it is likely to be very volatile in markets because we've seen the last few weeks when we get data, big variations, market's going to move on it.
Yeah, it's an interesting one. And of course, it is a very, very busy week, as you've just brilliantly outlined. But of course, it comes in a week that has a US long weekend right at the beginning of it, and a week that is likely to see conditions, at least at the start, and you probably expect towards the back end of it as well, relatively thin in terms of both trading volumes and liquidity. So if we do get any big deviations from the consensus expectations, then as you say, we could see a fairly chunky move. I think just in terms of what to look out for, you rightly pointed out the prices paid numbers. I think they are of much more importance in terms of the services PMIs rather than the manufacturing PMIs, because if you look at the way that inflation is coming through, it is much more price pressures in terms of services rather than in terms of goods that is keeping inflation elevated. That's certainly the case here in the UK, and I think that's true of the US as well. So that's why they are very much worth watching. And actually, the services PMI is just the headline number there. It is, as I said, the services sector that's not just underpinning inflation, but also that's underpinning economic growth more broadly. So they will be very, very interesting indeed. I'm not sure the ADP number is really worth our time, given that that's more of a random number generator than the one that I use to come up with my payrolls guess, which will be going in due course for the Forex Analytics sweepstake, which is running on their Twitter feed if Twitter is working. And actually, the initial jobless claims number as well, I think it takes on slightly less importance this week than normal because it doesn't reference, and nor does the continuing claims number, it doesn't reference the period used for the non-farm payroll survey. So just bear that in mind. If we do get a big miss or a big beat on those jobless claims numbers, it's unlikely to lead to anything in terms of the payrolls number on Friday. And then, of course, we've got that big jobs report. Who cares about Canada? It's all about non-farm payrolls on Friday lunchtime. We've had, I think, is it 13 or 14 beats in a row now compared to consensus? Are we going to get another one? You would assume so, given that no one seems to show much desire or an inclination to revise their forecasting model at the moment. But the things I'm really going to be watching is, one, wages and earnings. Do we see real pressure building there? Is that more inflation coming down the pipeline? And also unemployment. We saw that unexpected rise to 3.7% in the unemployment rate in the prior payrolls report. Do we get a further rise? If we do get a further rise, what's driving it? Is it joblessness or is it an increase in participation? If it's the latter, the Fed aren't going to mind too much. If it's the former, then we're going to see the first signs, and this isn't my base case, but that would be representative of the first signs that maybe, just maybe, the labour market is starting to exhibit a few little cracks here and there.
Yeah, absolutely. And going back to the ADP, the thing you have to look at with ADP is if there's a big variation, that moves the market. If it's expected at 200 and it comes in at 178 or something, the market doesn't do a lot. But if you're expecting 200 and it comes in minus 50k, the market is going to jump all over that, and it is going to, obviously change its expectations for the NFP. NFP could come in 500,000 on Friday, it won't matter. But it's the bit in between, and markets have to trade in between, and that's what we need to look out for.
Yes, of course. And just the final thing on that is that the ADP number only references the private sector. It doesn't reference any government employment. So do bear that in mind as well. I want to talk about summer, which is quite ironic because I think it has actually just started raining out the window, but never mind. That is me jinxing things once again. The reason I want to talk about summer is not because the trade-off is suddenly becoming a weather forecast, but because if you look at the calendar, it is obviously the start of July, and this period between Independence Day and Labor Day is generally what most people would consider summer, particularly in the United States. Schools are finishing up. People are taking their holidays or their vacations if they're American. And we're likely to see desks start to thin out in terms of headcount. We're likely to see just general interest in the market dry up a little bit as you do see volatility fall. You do see liquidity start to become much thinner than usual at this time of year. And then things pick back up again in early September. And you're already starting to see signs if you look at some of the implied volatility gauges that are out there. The VIX is still very, very close to the lows that we saw just before the pandemic kicked off in February of 2020. The MOVE index, which is a measure of implied volatility in the treasury market, that's at its lowest level in about 5 months. And in the FX space, implied volatility for most G10 currencies and most G10 pairs is pretty much at or as near as makes no difference at the bottom of the 52-week ranges. And you see subsequently realized volatility coming lower and also volumes coming lower as well. And the reason I mention this is really threefold. I think, firstly, it's important to be aware of the general market conditions in which we're currently trading, because that has a significant impact on the moves that we see. For example, if there aren't that many market participants involved at any one particular time, what we typically consider big economic data releases might not elicit the usual reaction that we would expect. But on the flip side of that, if we do get a big deviation from a consensus on one of these big numbers, be it NFP, be it CPI, whatever it may be, then you can see some bigger and more surprising and very, very choppy moves than we would otherwise expect. And that leaves you with a decision as a trader. You know, you've got your plan going into the release. If we do see a big unexpected move, do we get to a level that you've defined before the release? Do you trade off that level? Do you fade the move? This is something that you've got to put into your thought process. And of course, the final point I want to make on this is that often at this time of year, if you think about the institutional level, the sell side, the banking situation, desks are usually not staffed by the most experienced people in the room. It's usually the more junior members of staff who are on the desks at this time of year. So if you do start to see, let's say, a black swan event, a bit of unexpected news, a bit of turbulence in the credit market or in the financial plumbing space, I'm not saying these are going to happen, but if we do see these sort of things happen, it's generally an event that will catch people off guard. And as a result of that, you can just see liquidity almost dry up in an instant. So the real message here is not don't trade. I think there are still plenty of trading opportunities out there, and we'll get on some of those in our charts momentarily. But the real message is, if you are trading during the summer, more caution than usual is required. And I would say if you are taking a break during the summer, take a break entirely, and as much as you can, I would say probably close most of your book. Ryan, what are your thoughts on the summer situation?
Yeah, summer trading can be very difficult at times. Excuse me. Because we do get that drop off, we do get tight ranges. I think the important thing for traders is you have to be very careful with your charts. Pick the levels that you really feel are strong. If you've got good ranges, I'm not talking like trading a 15-minute chart, but if you've got decent ranges on an hourly, 4-hourly chart, just have some patience. Wait for your levels to come to you. Try not to get stuck in the middle. You don't want to trade a 20-pip move in euro dollar on a data point because you think it's going to reverse and then find you're stuck in a position offside for the next 5-6 hours. So you need to be careful. Pick your levels, pick your ranges, have some patience. But as Mike says, if there's nothing going on, go and look and do something else and leave your account alone.
Yeah, absolutely. And I think that's really important. You know, over trading can kill a lot of accounts. And if there is nothing going on, we're sat here on Monday afternoon, as we said earlier, there's not particularly much going on in the markets at the moment. I would expect tomorrow to be relatively quiet as well. Hopefully that's not famous last words. If the trade isn't there, don't go hunting for it. Wait for it to come to you. And in the meantime, go and watch the football or do some knitting or something, whatever floats your boat.
Yeah, exactly. I mean, I'm not doing much today. one trade I'm sitting on at the moment. I've got a couple of buy stops in above 145 in dollar yen, just in case we get a break of that big level there. But as we sit here now, it's trading 144.40, so that looks well out the window. But those are the types of levels you want to be looking at, levels that are confirmed as decent technical levels and are going to give you something to do against rather than getting stuck in the middle.
Absolutely. Well, let's look further forward once more into the rate curve.
Yeah, well, as we mentioned, you know, the next real trade is going to be when central banks start cutting rates. And I think that's going to be the real battle in the second half of this year between the central banks and the market. In the red corner, we've got central banks who won't be letting up on their higher for longer message, even if inflation falls back further. And in the blue corner, we have the market doves who will be waiting to pounce on any negative economic data to start trying and trade the eventual cuts to come, because cuts will be coming at some point. For now, central banks are well ahead on points in the literal sense too, as some of them are still hiking or looking to continue hiking. But the higher they go, the bigger the doves are going to hit if the data starts turning. So they're going to hit much harder if the data starts turning, because they're going to see that rates are going to have to come down from higher levels. And if they do start coming down, they may have to come down with some speed. So for the neutrals and the hawks, soft landings is where we're at. But if the hike lag is really yet to hit, we could find a lot of those moving towards the doves corner if indeed the data does start falling off a cliff. For us traders, it's time to put the gloves on and be ready to roll with the punches.
Absolutely. Before we do that, are you going to give us your little Prince impression, given the little subheading down there, or are we saving that for a later day?
No. If you ever see me in karaoke, definitely not.
I'm going to get you a little raspberry beret for next time. Right. Anyway, in terms of central banks, and I've run out of puns now. Yes, I think you're absolutely right. It is really a question of, you know, where I think the three questions for me in terms of monetary policy now are: one, where is the terminal rate for G10 central banks? I think we're getting close to it. I think for most, we can probably pin it within sort of 25 basis points of where we're likely to get to. The second question is going to be, how long do we stay there? And that's where we come back to some of the economic data that we were talking about earlier. One thing, of course, we haven't mentioned is the housing market. We know that we've got this mortgage cliff here in the UK. You've got similar in Australia. You've got similar in Sweden as well. But housing more generally, how is that going to hold up given the rate rises that we've seen? And then the third is, who cuts, at what speed, and to what degree? Because, of course, and I know we've mentioned this before, and I don't want to sound like a stuck record here, but policy is now pretty much everywhere, I think you could say, apart from in Japan, of course, in what we would call restrictive territory, i.e. central bank rates are above the neutral level, which is where the economy just kind of bubbles along. Inflation's stable, employment's stable, and rates are at a neutral level, which is probably about 3%, I would imagine, for most developed economies at this stage. Central banks have had to get rates quite considerably above that level in order to bring inflation under control. They let that genie get out of the bottle, and the only way to try and put it back in was to move rates quite significantly into restrictive territory. So the question now is, who wants to get back to neutral the quickest? And that is, I think, really what we're going to be looking for in the second half of the year. So it is a case almost for traders of being as data dependent as the central banks that we're trading. As and when releases come in, that changes the macro picture. If we do see some significant softening, for example, in Canada, then you're really going to see bets ramp up that the BOC are going to be one of the first to loosen, and the Canadian dollar is going to weaken off as a result. That's just a purely random currency I've chosen there. I think actually the Canadian economy is really the kind of fairy tale story at the moment. But this is really what to watch in the second half of the year. It's what's going on in labour markets, what's going on in terms of activity, what's going on in terms of housing. Where are we starting to see those cracks emerge? Where are more of those cracks emerging? And where, and this is where the really boring part of trading comes in, and you have to read those central bank speeches, where are policymakers starting to get really quite worried about what's going on?
Yeah, that's right. And it's very important for trades because this is when you catch the big moves. It's okay trading the data day to day, as we're going to be doing. Good data, dollar goes up. Bad data, dollar comes down. But if you start to see trends in certain data points, and you can look at some of the weekly ones, like the NBA mortgage applications, that could be a good precursor for the housing market. Jobless claims, another one as well, data in between the big jobs numbers. If you start to see trends there, that's when you get a good early opportunity to position yourself for potential cuts to come. And if you get in early enough, then you can ride it for some huge pips.
Absolutely. And of course, the last point I would make on this is, given the theme of rate cuts, there's so many ways to play it. You can play it through the FX space, you can play it through the rate space, you can play it through the STIRS space if you really wanted to. It is a theme that you can actually leverage and get exposure to very easily in a number of different asset classes, whatever floats your boat, really.
Yeah, and remember, you don't have to play it all against the dollar either. That's going to be the bigger mover, but you're going to have divergences the opposite way. UK, BOE and the ECB, you've got RBA and RBNZ, loads of different cross pairs you can play to nick in between those different divergences.
Absolutely. Right, with that said and done, let's get on to some charts, shall we? Right, I want to start with the Aussie dollar this week. As Ryan said earlier, the RBA will have announced policy by the time this show airs, so this is going to be brave. I'll caveat this initially by saying that if the RBA hike and or deliver a ridiculously hawkish message, then we're going to see the Aussie dollar rally, of course. So you might want to disregard what I'm about to say, although I wouldn't expect us to get much above the top of the recent range, around that kind of 67, 85, 68 level. But if we do, then that may be an area of interest if you were looking to be long. But given how the land lies at the moment, I think the trend in the Aussie dollar is a little bit concerning. Now, consider, of course, that the Aussie dollar is a high beta currency. It typically displays a very, very strong correlation with risk assets, with the S&P 500. As we said in the introduction to the show, the S&P 500 had a blockbuster start to the year, and it's had 5 out of 6, or even 6 out of 7 now, weekly advances. But over the last couple of weeks, it's really all been one-way traffic for the Aussie dollar, and that has been lower. And if the currency can't rally when risk is ripping higher, that, to me, is a bit of a concern for the bulls. And especially from a technical level, of course, we've now had a closing break below that 50-day moving average. That came last Wednesday. We retested it on Friday. We retested again this morning, and we've kept below it. So those moving averages, that 67 region, a few pips either side of that, starting to mark itself out as very, very strong resistance. I think the Aussie dollar is focusing a little bit more on the China narrative at this point. The slowdown we're seeing in China, the lack of any reopening bounce or impetus that's coming through there. So I think personally, I'd be looking to play this from the short side, providing there isn't a curveball from the RBA, because I think it goes back to that old thing. If a currency can't rally when it should, then when is it going to move higher?
Yeah, no, absolutely. I think this one's also been under the cosh due to the manufacturing data that we've had out. Obviously, soft manufacturing means softness for commodities, and that's a big part of the Aussie dollar, obviously being a heavy commodity currency. You're quite right. It's a decent confluence of moving averages on the daily chart there, and I love a good confluence. It gives you good levels to lean against. I think you're also absolutely right. If we get any sort of rally up to 67, even above 67 towards 68, that might be a bit of a gift for shorts to take a pre or post RBA trade on that one. But like you say, I don't see any significant reasons why this goes much higher. But again, we're not going lower either. So that 65.80 level you've got on your chart is very important. If we break that, then I think we're on for a bit more pain.
Yeah, absolutely. I mean, as I say there, we're still in a range that we've traded by and large since February. I mean, we've been stuck between 65 and 69. What's that? 4 big figures, even if I can do my maths, for the last 5 months. So, it is a case of watching the top and the bottom of that range as it is in so much of G10FX at the moment. But the yen is most certainly an exception to that.
Yeah, and this is one you spoke about last week as to, keeping eyes for warning signs of whether the carry trade is coming near an end or may come near the end. And we've definitely seen a slowdown in yen selling. Maybe, again, a big pinch of salt due to the month-end flows that might have been at play last week. But based on the numbers, there's has been a marked slowdown, and even some strength versus some other currencies. Now, here's a chart that I've knocked up, and it's the top half is from way back in June 12th to 16th when I brought this up last time. You can see the weakness there, all those currencies gaining versus the yen, 4%, nearly 5%, 3%, 2%, 3%. You know, we know how fast it was moving then. Last week, the numbers much smaller, as you can see there. You know, not even percentage marks, whole percentage marks for a lot of currencies. And as you can see down the bottom there, 4 or 5 currencies actually seeing some yen strength. So are we at the end of this selling pressure in the yen? Is it just a bit of a pause? Maybe we need to see the global fundamentals and not quite in line for the yen as well. But it's going to mean that if we do get a change in those fundamentals, if we do get weakness, it's not going to be the yen that's strengthening, it's going to be the other currencies weakening. But it could mean, if we don't, that we get these yen sellers getting back on the bus this week, particularly if the data, you know, comes in strong in the dollar's sake. Japan as well, if that data still looks like it's coming in better as well, then you know, we could have a bit of a fight on our hands here, depending on whether we see further weakness or whether we see some strength. But on balance, I think you know, the MOF are going to come under pressure if we do see yen sellers getting back on this bus and pushing yen pairs much higher. Dollar yen, if we get through that 145 area, we could be off to the races. Going to speak about that a bit more. But yeah, it's on a bit of a knife edge at the moment as to whether we're truly seeing a slowdown in the weakness or just a pause.
No, it is. You're right. You were in danger of stealing your own thunder then, which would be quite something. I think it comes back to what we were saying a few weeks ago, and I think what everyone was saying when this was last a thing and last a real big narrative, kind of October last year. What really worries the authorities in Japan seems to be the speed of the move rather than necessarily the absolute level that we trade. I don't think, and I can't speak for them, of course, the MOF particularly worry if we trade 146, 147, 150 if we get there over the next 6 months. And the economic fundamentals justify it, which at the moment, with the Fed continuing to raise rates, other central banks raising rates, and the BOJ sitting on their hands, it does. If we see another few weeks where, you know, dollar yen is rallying, 2%, 3% over the course of the week, we're seeing even bigger moves in some of the crosses, then that is going to be of a concern for the BOJ and for the Ministry of Finance. So it's definitely an interesting one to watch. I think if the pace of selling continues to slow, as it has done over the last week, if it continues to do that, then it does decrease the chances, in my view, of anything going further than this kind of verbal jawboning that we've seen at the moment. But of course, we need to be on guard because we know that the BOJ, the MOF have surprised in the past in terms of the intervention, and there's every chance that they could do so again. But thus far, all the signs are that things may be starting to calm down a little bit.
Yeah, and you make a good point regarding the crosses as well, because what's different this time to what we saw when dollar yen was running up to the 150s is that back then the yen crosses weren't following suit. They were going higher, but they were much more suppressed. Now a lot of these crosses are higher than they were back in September, October last year. If you look at the trade weighted index for the yen, it's coming down to levels where they did intervene last time. So it might be a fact that it's not just dollar yen that they decide to hit. They could, in fact, go into one of the other currencies, euro yen, for example, and that's where they do the bulk of their intervention. So it's going to be a messy one, whatever they do, if they end up doing something.
Yes. The other one that's attracting a lot of attention in some of the sell-side notes that you read is the yen against the Chinese renminbi or yuan. That's getting very close to the 20 level, which again, as you mentioned in terms of trade-weighted yen, that is very, very close to the level where we were when they last intervened. So I think that's another one that's going to be watched closely, given the trading relationship that's going on there. We could talk about the yen and FX intervention all day, but we're going to get told off if we do. So let's move on. I mean, we'll get back to dollar yen in a second, as you can see there anyway. Before we do, I want to just talk very quickly about the yield curve, the treasury curve, of course. I think I mentioned earlier on, and as you can see in the chart, the 2s, 10s segment of the curve, which is by far and away the most closely and keenly watched part of the yield curve, is around about 5 basis points, actually slightly less than that since the market opened this morning, away from the lows that we saw when Silicon Valley Bank and all of the other regional banks in the US and, of course, Credit Suisse were starting to go south. That was around minus 110 basis points. So we're very, very close to that now. And I think the move that we've seen in the curve over the last week, but actually over the last 8 weeks now, in terms of the bear flattening that we've seen, which is where front-end yields are rising much faster than their counterparts at the long end of the curve, it's telling us a couple of things. It's showing us, firstly, that the market is really starting to price in this higher for longer message, given the move lower that we've seen in the curve. It's a sign that the market is finally starting to actually buy what the Fed has been selling. And I think some of the data we saw last week and the relatively hawkish remarks that we got from Fed Chair Powell on his panel at Sintra, albeit I was at Lord's, but I did catch up on it later on that night. They were really sort of forcing the market to actually finally sit up and take notice of what the Fed have been saying for so long. But of course, the converse of this is, because it's been a bear flattening, because of this deep inversion, the market's still saying, yes, we think you're going to raise rates further. We expect more tightening in the near term, but we think you're going to over tighten. We think that's going to lead to a slowdown in the economy. But what I would just say, and I'm keen to get your thoughts on this, Ryan, if you look at that chart, look very, very closely at those red shaded areas. That is the when the US has experienced a recession, as per the NBER definition of it. A recession and the timing of that recession is not dictated by when the yield curve inverts, when it goes below zero. The timing of that recession appears, from the chart and from the data, to be dictated by when the yield curve begins to re-steepen. And I think we're quite a long way off that at the moment. So although the curve is at its most inverted since the 80s, and we're going to hit that level again, I would have thought, a little bit later on this week, as far as I can see it, as far as the bond market's saying, and as far as the data is saying, I think the US economy has a little bit more left in the tank for now.
Yeah, and you make several good points there. The first is with over-tightening. Considering the Fed and the other central banks didn't do enough at the start in recognising the problem that was coming, they can over-tighten because it's in their interest to do that. They'd rather over-tighten. We've heard all of them saying, it doesn't matter if we over-tighten because they can always bring rates back down again. So the market may be worried about it. Central banks won't be. On the other side, what's a recession going to be looking like? There's different types of recessions. There's technical recessions, which for a lot of countries is 2 quarters of negative growth. Now, if that means 2 quarters of minus 0.1% growth, that's a recession. It's not something you're going to blow up the books about and have everyone running around with their hair on fire. But
well, you wouldn't be.
You're like me. I've been through a few recessions, as you can see. But if we start getting a real economic slump, and that's negative 1% GDP, things like that, when consumer spending falls off a cliff, activity really slows down, that's a whole different ballgame. So the market's got to be a bit careful in how it trades in a recession and what a recession is going to look like. As you say, one could come, and with the lag of interest rate rises, we could see that. My base case for most of this year has been that we see probably flatlining growth, maybe plus minus 0.5%, that sort of thing, for a lot of economies. So we're going to see potentially some recessions, but as long as they are not deep slumping in economic activity, the market can trade them away and pretty much ignore them, and so can we. But as you say, the more extreme a market prices something, like you've got the inversion showing there, the more reactive it will be the other side if that doesn't come to pass, or as we like to say, running from one side of the boat to the other. The more extreme it has, the more the market will move between those extremities, and that's what gives us trading opportunities.
Absolutely, and that's what we're all looking for at the end of the day. Speaking of opportunities, what about dollar yen? I mean, we haven't spoken about the yen enough today, have we? Really?
Well, it is a hot topic. You might as well speak about it rather than the Brazilian real Polish zloty cross, which I'll leave to you to do next week. There you go. I've set you up for that one. 145 has shown its colours in dollar yen. This was, it was found wanting at the first attempt. And again, month end looked to be in play. The only time it actually broke the 145 was in the Japan time over the Gotobi fix, which was the last fix of the month. That's when we saw that move up above 145. It hasn't been above since. And as well as market players that have been focused on this level as a possible line in the sand for the MOF, we've been highlighting it quite often now as a big technical level too. It was a huge level on the way up on the rally last year, and indeed on the move back off those highs. You can see there's a couple of candles that touched that level and bounced just before we got the big breakthrough. So as of now, it's held off sellers at the end sellers at the first attempt once again. Now, it's levels like these that traders really need to have on your charts for all times, as it's one of those that will have us saying things when we revisit them after we've been away for a while. So for me, if we do break this level now, I think it will be a proper break. It will be different to the 145 break we saw last week. And I don't think we look back until maybe somewhere like 147 if that happens. So if we get a test up there and we do get another break, I think it's going to fly.
Indeed. I don't have anything else to say on the yen. I exhausted myself earlier on, and unlike you, Ryan, I couldn't talk about the yen all day. So, Kyriakos, roll the titles for our plays of the day.
That's a first leaving you spoke, not for words.
I know, it doesn't happen very often, that, does it? Someone should record it. Right, I'm probably going to get told off or get given a yellow card for bringing this one back, but I'm going to anyway. It's our old favourite, the S&P 500. Why not? It's had an absolutely blockbuster first 6 months of the year, rallying 16% or so. And it's the same old argument. You know, there are still bearish voices jeering from the sidelines as there have been for some time. But the market just keeps climbing that wall of worry. It keeps ably dealing with anything that's thrown at it. And dips are still being bought into pretty aggressively and pretty quickly, as you can see with that dip we had below the 4,400 handle towards the beginning of last week. 4,500 is going to be an interesting level. The market couldn't quite get through it towards the tail end of last week. I wouldn't expect us to get through it in pretty thin trade at the start of this week. But if we do get a closing break above, that gives a good chance to add to any long positions if we get it on a closing basis, of course. And I would still be looking to buy into any weakness if it were to occur. You know, the market continues to make new highs, higher lows. It's a pretty clear uptrend that we're in at this point. You know, I could go on all day listing bullish arguments, but just go back a couple of episodes because they haven't changed from then. Stay long and strong on the S&P 500 is what I'm doing. Ryan, what about the yellow metal?
Right, I'm going off the cuff here. I reckon we should get some of our viewers who watch this show to come on and give us suggestions for players of the day. Because if you keep going with that S&P, I'm going to do dollar China for the next 6 shows. So let's stem that out right away. So, boys and girls, if you watch this show regularly, give us some ideas for plays of the day. Pick them out of anywhere you like, and we'll have a crack at them. But yeah, for now, I'm going to be looking at gold, which was my play of the day a couple of weeks ago. So yeah, I'm in the same boat with you, going back over old ground. But there are times when traders really shouldn't be pigeonholed into steadfastly picking a side, like a buy or a sell. We're not here to favour a bias of any asset, like we hear about perma bulls in sterling, for example, Michael, or perma bears, sorry, or bull. So yeah, as I said, gold was a play of the day a couple of weeks ago. I was looking at longs into that 1915, 1900 area as a potential range bottom. That worked out. You could have grabbed some pips off of that. So now I'm looking at this from the same side again, but I'm not going to be sticking to one side. We tested the 1900 area last week. It broke down to the fib there, just nicked under the fib, the 38.2 fib you can see there. Didn't last too long, got back above 1900, but it's not looking too hot at the moment. We had a bounce into the 20s, quite a strong bounce, but that's as far as it's got. We have got a level up above at 1935. If we can't get above that, it keeps this short-term bearish pressure on. I don't think we're quite done with this 1900 level, but if we get down there and it holds a second time, that'll give longs some conviction to try and get in there again. But look for a break. If we get a break of 1900 and indeed that low, maybe wait for a confirmation, i.e. a retest of those two levels. If they hold, then I think we're heading much lower, and that's when you're going to be looking to get into shorts on that one.
Well, let's see what happens. That brings us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me, and to our producer, Kyriakos, for bringing this together as brilliantly as he always does. All three of us will be back again this time next week. Thank you very much for watching. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, and we'll see you again in a week's time. Thanks as always, and goodbye for now.